Welcome to TheoTrade. This is Don Kaufman. It's November 12th, 2018, and you are watching the TheoTrade evening video. Once again, another round of heavy sell-side activity. The S&P futures, well, ending down just shy of 50 handles. That is 50 points for those of you that do not necessarily speak Trader Geek. And quite ironically falling directly, I mean dead on, 27.31, which for those of you that do tune in from time to time, that's our gravity point. Now, there's a lot to kind of take in on a session where we see such dramatic sell-side activity. However, at a point in time like this, it's where you have to focus your attention to a few very, very key areas. And that's really what I want to do on this evening's video. So, regardless of your profit and loss per se on an individual position, we got to step back. We got to focus a little bit more big picture, because for the first time in the last approximately 2 weeks, we saw some real damage done inside of the broader marketplace. Let's get started with this, and let me really dig into what matters most right here, right now. Okay, again, everybody's attention is focused on the S&Ps or in the Nasdaq, or better yet, they're focusing on Apple. Well, it's okay to focus on Apple a little bit. I mean, hey, after all, the single largest market cap inside of the S&P 500 in the known universe, falls by 5%. That absolutely should grab your attention. But underway is a much more substantial and important area, and it's something that we happen to actually focus specifically on in this weekend's update. Let me get right down to it. One of the final thoughts I gave you on the weekend update had everything to do with the Dow, and that it was only a matter of time before quantitative traders turned their algorithms towards some of the largest market caps inside of the Dow. Now, for those of you that don't necessarily look at the Dow, we're going to take you into that a little bit deeper. Obviously, this is a heat map. We're going to cruise over to quotes over here, and we're going to pull up the Dow. I'm going to go ahead and I'm going to close up that left side bar. Now, what I've done in the Dow is I've actually sorted, and again, these are the Dow components, kicking off with Boeing, United Healthcare, Goldman Sachs, and all I've done is actually sorted, by price, because the Dow is all about, well, if you're a $357 product, you mean more than a $270 product, Take a look at the key components, the largest components, if you will, inside of the Dow. Absolutely is going on, and they're going to decimate them. What are we actually seeing? Boeing, a $12 move. Now, normally I focus a huge amount on percentage change. Why am I not focusing on percentage change? Because percentage change doesn't mean all that much in the Dow. The Dow, is everything about how many dollars do these individual stocks move. Goldman Sachs, just lost and gave up what? 7.5% in one trading session. Boeing, $12, good for 3.33%, and we can go on and on. Obviously, Apple, even McDonald's, which we happen to hold a position inside of McDonald's, down nearly 1%. And the reason I mention McDonald's, specifically, this has been used as a hedge more recently. So what you're getting, again, is this systematic dismantling right now, of key components of the Dow. Why? Well, to bring the Dow down. There's just no question about it. They're actually turning algorithms towards, the stocks that influence the Dow the heaviest. Another way to actually look at this and kind of interpret it isn't necessarily looking by the quotes. You can actually look under this visualize here, cruise over to index watch, and pull up the index itself. As we pull up the index, to do that, we'll actually pull up the Dow. Take a look on a percentage basis. What's actually getting rocked the most? What matters the most? It's Apple, it's Goldman Sachs, it's Boeing. Think about that for a second. They're literally turning the algorithms toward this. Now, the reason I say that this is what matters most right now, there's no fundamental, reasoning behind it. There's not even like a technical, if you're looking like, well, what's the MACD? What's the Fibonacci? Oh, what's my Bollinger Band saying? Okay. This has to do with quantitative finance. And again, it has to do with a lot with arbitrage. And that is, you can actually influence the entire Dow if you can influence 3 or 4 stocks. And I'm sorry, but that's the world that we happen to live in. And you look at this and you think there's no rhyme or reason. Okay. That's one of the key components. Are we going to see continued sell-side activity in these large components? Because you have to recognize, again, how this marketplace will effectively work. Take Goldman Sachs, for example. Goldman Sachs hammered inside of today's trade. Look how linear some of these moves happen to be. It's almost too smooth, for the taking, meaning that, this is just algorithms throughout the course of a trading session hammering away. You don't even see any huge volume spikes until the very last second of the trading session, which is what we would expect of algorithms. No large trades, breaking it up, small pieces. The same thing happens to be relative inside of Boeing. Apple, it's the exact same animal. Again, dismantling some of the bigger components of the Dow to ultimately bring the index down. Why is it disconcerting? The question is, in the next few days, are we just going to see this continue? Are the algorithms now going to effectively take the market down similarly to the way that they rallied it back up? One of the things I did over the weekend video was actually showing you Microsoft. If you take a look at something like Microsoft, and I'll just bring up a 3-year, when I talk about how linear moves happen to be, this is what I mean. But that's what you just saw today, intraday, unfortunately to the downside. And I'm using Microsoft because this happens to be precisely where we just took a bearish position. Microsoft bearish position working out extraordinarily well, given the fact that we just got into it. Just 3 days removed, and this happens to be a duration position. So why so bearish on Microsoft? Because if you look at it on a year-to-date percentage, and if you understand anything about quantitative kind of finance, it's up 24%. Again, no fundamental reasons other than the fact then they haven't hammered it. And if the market's going to get hammered, they're going to come after Microsoft, just like they're doing, to systematically dismantle other products. The next thing that needs to come into scope, financials. All right, the financials got nutty in today's trading session. Obviously, Goldman Sachs kind of leading the path, but 2% inside of the financials. Now, why do I say this a little bit nutty? Listen. 2650. Mark it in your head. 2650 inside of the financials. We're just north of it. We crack below it, it's on. What's on? It'll be all out sell side activity to the broader S&P 500. Plain and simple. It'll be all out sell side activity. At that point, you got to worry about 2682. You got to worry about 2626. You got to worry about cracking under 2575. Use the financials. Why? They're the marquee product right now. What the financials are doing is dictating the S&P. Put the Nasdaq aside for just a second. We know the Nasdaq is under duress. Yeah, newsflash, the Nasdaq is under duress, right? Right now, if you're looking at the broader markets and you're thinking about the S&Ps, it's the financials that actually are the linchpin. And I've talked about this ad nauseum now for months. Moving away from the financials. The financials, listen, it is the thin red line. Right there, 2650. Under it leaves the S&Ps completely exposed to the downside. Now, continue on with this. Last, but definitely not least, we have to take a detailed look once again at the SPX, because there's something that I mentioned, and I'm actually going to bring up, our expected moves. For those of you that do not tune in, the expected move is what? It's effectively what the options market is dictating risk to be a week ahead. And the expected move this week was just around $50. It was just shy of $50. That means we're going $50 higher or $50 lower. If you look at this like an expected move, on a distribution, this is the starting point for the week, which is right there. We can go up $50, down $50. Now, what did I tell you, kind of in the weekend video? Do not sell short duration options. Doesn't look right. And meanwhile, on Monday, we just moved $54. We moved $54 when we were supposed to only move $50 for the entire week. It doesn't mean that it's all over but the crying. But take a look now at the option chain itself. You look 4 days out, they actually expanded the expected move. So when options are supposed to decay, they didn't decay. They actually increased substantially. Now we have a $55 expected move, and we just saw a 55 like move. Like we actually moved 55 bucks, and they just tacked on another, what, couple of bucks to the expected move for the remainder of the week. We sit in a very precarious place. And again, I know everybody's like, well, what positions are you taking? I've taken my positions. I've got bearish positions left and right, up and down. Okay, we've taken our positions. At this point, we sit back. And when I say that this is absolutely critical in the SPX, cannot stress this anymore. We've now breached the edge, okay, of the expected move. And an interesting, okay, kind of irony lies right on the edge of the expected move. The expected move inside of the SPX, it just so happens, and it just lined up this way, okay? It just so happens that it lined up with the E-minis right around 27.31. If we crack outside, again, outside of this expected move tomorrow, Wednesday, if we go any further outside of that line, and that is, again, talking about the thin red line over in the XLF, this is of critical importance as well. The XLF comes under 26.50, and the SPX starts to sell off even mildly. What'll have to happen is trading firms are going to come in and they're actually going to sell into this. Why? They have to dynamically hedge. So for the most part, if you went out and you've sold options in here, the only way to hedge yourself is to actually sell into the selling. This is, we're right on the edge early in the week of getting what we term a 3 sigma move. Okay, and there's no way to distinguish if that 3 sigma move is going to happen. What's a 3 sigma move? We were expecting a 50-point move. We could actually snap, okay, and move, 100, 150 points inside of the S&P. There's no easy way to say this, okay, but we're actually faced with some of the most serious risk that we've actually seen yet. As I started this, okay, I said it's the most serious risk that we've seen in the last, maybe 2 weeks, right? Go back to the S&P futures. Okay, and obviously you would agree it's the most serious risk that we've seen anytime in the last 2 weeks. Okay, however, to be poised in such a precarious place early in the week, okay, puts us that much more on the brink. The last and final thought of this: the bonds were closed today. All right, it is Veterans Day, and thank you to any and all of you, okay, that had served, that are currently serving. It's Veterans Day. The bond market's closed. Why is that concerning at all? We did this kind of damage with the bond market closed. Wait till they open these things tomorrow. Are they going to buy up the bonds? If they're going to start buying the bonds out of the gate tomorrow, the S&Ps are going to be projected, okay, to tank. A lot to think about. Bigger picture, okay? Bigger picture. Keep an eye on the XLF. Keep an eye on these S&Ps. Any lower inside of the SPX, okay, and it's all over but the crying, okay, below, again, that 27.30, we could very well see a 3 sigma move to the outside. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.